This wasn't a silver rally. It was a leverage event that briefly broke the market's ability to pretend everything was normal. The tape didn't move like a commodity drifting higher on optimism. It moved like a system trying to survive a shock. And while most people argued about whether a major bank failed, the real mechanism was sitting in plain sight in the plumbing, margins, spreads, and the parts of the market that only matter when someone is forced to act. Stay with me, because by the end, you'll have a clean near-term checklist. The levels that matter, the curve signal that tells you whether this is over or just pausing, and the one kind of price action that would invalidate the whole thesis fast. Here is the conflict nobody wants to say out loud. When silver goes vertical late in December, the market's first instinct is not price discovery. It's damage control. Liquidity is thin. Books are being squared for year-end. Risk managers are already on edge because a single outsized move can turn a tidy year into a headline. So the system does what it always does in these moments. It tightens the screws. Collateral requirements get raised, limits get enforced harder, and the people who were comfortable yesterday suddenly have to come up with cash today. And that's where the real pressure starts. If you only look at the chart, you'll miss what this move actually was. Silver didn't just go up. It sprinted into record territory. Prints above the 88 handle were reported. Then it fell into an air pocket that looked like a flash crash to anyone who wasn't T watching the mechanics. Then it stabilized and bounced, because after forced liquidation, you often get the second order effect. The market finds out who actually needed out versus who simply got knocked out. But that's not the part that matters. The part that matters is what the market had to do to make that reversal happen, and what it will be forced to do next if the same stress returns. Let Yes pull the camera back for a second and talk about why people are even primed to believe the major bank got liquidated story. Because it feels true. A move like this doesn't look like a normal crowd of buyers. It looks like teleportation. It looks like bids lifting in chunks instead of pennies. It looks like a market that is suddenly trading liquidity, not valuation. And when people see that, they reach for the simplest narrative. Someone big blew up. Sometimes that is literally true. Sometimes a desk, a fund, a major leveraged player, or a prime brokerage client gets caught the wrong way, and the unwind has to happen quickly. But the word bank gets used loosely in viral posts, and the market doesn't need an official press release for a liquidation to happen. The plumbing can create a forced event even if no household name collapses on TV. That's the hidden detail. The market can manufacture a blow-up through margin and positioning alone, and it can do it fast enough that the rumor becomes the story. But the next detail is what flips the whole setup. When exchanges raise margin requirements after a volatility burst, that isn't a philosophical statement about fair value. It's a mechanical filter. It decides who gets to keep playing. If you're long or short futures with leverage, you're not holding a belief. You're holding a contract that gets marked every day, sometimes every minute in practical terms, against you. Your broker demands variation margin as price moves. And if you can't post it, you don't get a lecture. You get flattened at the worst possible time. And in a thin market, that flattening can shove price much further than fundamentals would justify. Because if this one level breaks, the math changes. Now add the calendar. Late December is when markets become fragile in a specific way. A lot of participants are not trying to maximize opportunity. They're trying to protect a year. That creates two behaviors that sound opposite, but actually reinforce each other. One, liquidity thins because people step away and dealers quote wider. Two, risk controls tighten because nobody wants an end-of-year surprise, so you get a market that's easier to move and quicker to punish. That's why year-end is notorious for exaggerated moves, up and down. It's not magic. It's structure. So what happens in silver when it starts ripping in that environment? The first wave is usually momentum and reflex. Algorithms see a breakout, they buy. Trend funds see a level go, they add. Shorts who have been leaning on a ceiling feel the ceiling crack, and they start covering. Then you get the second wave, and this is where it becomes violent, forced buying. Not because everyone woke up to the story, but because someone's risk model says, you are no longer allowed to be short this. That forced buying is not price sensitive. It pays whatever is offered. It climbs the ladder of asks. It turns a normal breakout into a spike. And once that's happening, the system reacts, because the system is designed to survive, not to let a single squeeze cascade into a broader failure. This is why margin changes matter so much in the silver story right now. They don't cause the initial move. They amplify the second move. Think of margin like the floorboards under a crowded theater. When everything is calm, nobody notices. When everyone rushes at once, you find out how strong it really is. Raise margin during a vertical move, and you're effectively saying fewer people can carry positions overnight. That forces deleveraging. Deleveraging means selling for longs who can't finance and buying for shorts who can't survive. Both can happen in different pockets at different times, and the sequencing is what creates those what just happened candles. And that's where most retail viewers lose the plot, because they mistake the whipsaw for randomness instead of mechanics. Here, it's the part that should make you sit up. The most important signal in a squeeze is rarely the headline price. It's the spread and the curve, because the spot print can be a mess. Liquidity, stop runs, liquidation, panic. The curve tells you whether the market is tight, whether nearby demand is urgent, and whether people are paying up for time. If you want the lie detector, you watch the relationship between the front month and the deferred months. You watch whether the nearby contract is being bid relative to the back. You watch whether carry makes sense or starts failing. In a calm market, contango, where future prices are higher than spot, reflects storage, financing, and convenience yield. In stress, backwardation, where near prices are higher than deferred, can show urgency. It can show that someone wants metal now, not later. It can also show a scramble for deliverable units in the system, especially when inventories are segmented in ways most people don't understand. And that's not a conspiracy, that's inventory reality. Because inventory is not one number. There's metal that exists in the world, there's metal in a vault, there's metal that can be delivered against a specific contract in a specific form on a specific timeline. There's metal that owners are willing to part with at the current price. And there's metal that is technically present but economically unavailable because it's earmarked, leased, pledged, or sitting behind logistical constraints. In a squeeze, the only inventory that matters is what can actually show up on time, in the right form, in the right place. And when that deliverable pool is perceived as tight, the curve starts talking loudly. But that's not the part that matters. The part that matters is what it forces participants to do. If you are short nearby futures and the front end tightens, you're not just wrong, you're potentially trapped. You can roll, but rolling costs money if the spread is screaming against you. You can deliver, but delivering requires you to source deliverable metal, which may not be as frictionless as a spreadsheet assumes. Or you can buy back the position, which becomes forced buying if you're under margin pressure. And in a thin year-end market, those decisions get compressed into days, not weeks. That S where the story of they got liquidated becomes real, even if the identity of they is never officially confirmed. Now let Yes address the viral bank rumor the way a professional would, by separating what S provable from what S plausible. What's provable is this. Silver experienced extreme volatility into year-end, including prints around record territory and a sharp drop shortly after. It was volatile enough that the exchange environment responded with tighter collateral requirements for precious metals trading. That is a real, documented response to risk. What's plausible is that within that volatility, one or more leveraged players got hurt badly, because someone always does when a market moves that far, that fast, into thin liquidity. But the leap from someone got hurt to a major bank failed is where the internet takes over, and the internet always chooses the most cinematic version because it spreads faster. So here lies the framing I want you to carry. Whether or not a household name bank failed, the silver move behaved like a margin squeeze that created forced flows. That's the real story. Because if it's a margin squeeze story, it can happen again, and you can watch the setup forming. If it's a one-off secret scandal story, you can't trade or manage risk around it, you're just consuming a thriller. The next detail is what flips the whole setup from entertainment to actionable understanding. Silver is not just money-themed, it's industrial. That dual identity is why it behaves differently from gold when regimes change. Gold can trend with macro narratives and central bank behavior. Silver can do that and also get yanked around by real procurement, manufacturing cycles, and supply chain bottlenecks. And silver supply has a specific vulnerability. A meaningful portion is produced as a byproduct of other mining: lead, zinc, copper. That means silver supply does not respond cleanly to silver price in the short term. If silver doubles, you don't necessarily double silver output next quarter. Lead times, refining capacity, and the economics of the primary metal all matter. In other words, higher silver price doesn't instantly print more silver. That's a structural constraint. But it doesn't mean guaranteed shortage. It means the supply response is slow. And in a leveraged futures market, slow is all you need for violent moves. Now stack the evidence the way the market actually stacks it, because one argument never drives a move like this. First proof point, the calendar. Year-end thin liquidity is real, and it makes moves larger than they'd be in April. Second proof point, margin policy changes and risk tightening around the volatility spike. Whether you love it or hate it, when collateral requirements rise, leverage shrinks and forced de-risking follows. Third proof point, the shape of the move itself, vertical advance followed by a sharp air pocket. This is classic of a position-driven event, rather than a slow fundamental repricing. Fourth proof point, cross-market behavior. In a stress moment, correlation shifts. You often see risk assets not behaving the same way as a metal doing its own thing. Fifth proof point, curve behavior and spread action. If the front end stays supported relative to the back end, even after a dump, that's a sign the physical or deliverable urgency is not fully relieved. And if that spread starts tightening again on the next push, you're back in the danger zone. And that's where the real pressure starts. Now the paper versus physical tension. Let AS talk about it without turning it into a fairy tale. Futures are a price discovery mechanism, but they are also a leverage mechanism. Physical markets have frictions: fabrication, transport, premiums, delivery schedules. In a volatility event, the paper price can crash and rebound faster than physical supply chains can reprice. That can create strange optics. Paper dumps while physical premiums stay sticky, or retail availability changes in ways that don't match the headline chart. That does not automatically mean manipulation. It can simply mean physical is slower, stickier, and segmented. But when those segments stay tight while paper whips around, it tells you something important. There may be real demand underneath that doesn't OT vanish just because a futures candle turned red. And you have to understand one more mechanical lever that turns a sharp move into a spectacular one: options and dealer hedging. You don't need a full gamma dissertation to get the point. When a lot of call options exist at certain strike levels and the market starts rising through them, dealers who sold those calls may hedge by buying the underlying futures as price rises. That buying is also mechanical. It can reinforce an up move, reflexivity. The closer you get to key strikes into expiry windows, the more sensitive this can become. Then when the move reverses, hedges get unwound, and the same reflex can accelerate the drop. It's not a conspiracy, it's a feedback loop built into the structure. And when you combine that with margin pressure, the loop can snap from trend to event in a day. Because if this one level breaks, the math changes. So what does all this mean right now, not as a history lesson? It means you should treat the last week S-silver behavior as a signal that the market is operating under stress conditions, not just enthusiasm. Stress conditions create two outcomes that look contradictory: explosive upside and brutal downside. That's why people get emotionally wrecked here. They think volatility means their thesis is wrong, or they think upside means it's safe. Both are traps. Here's your psychology shield, and I want you to take it seriously because it asks the difference between surviving and becoming exit liquidity. In markets like this, volatility is used against you, even without intent. The structure itself weaponizes your emotions. Big green candles trigger FOMO and the fear of missing the move of a lifetime. The big red candles trigger panic and the fear of losing everything. The market doesn't need to target you. It only needs to be volatile enough that you abandon process. The solution is not to become numb. The solution is to distinguish trend signals from noise and to pre-decide what would change your mind. Trend signals are things like higher highs and higher lows over meaningful timeframes, persistent support at prior breakout zones, and a curve that stays firm in the front. Noise is the intraday liquidation and rebound that comes from leverage being forced out. Noise can be violent even when the trend is intact. And the more emotional you are, the more you will interpret noise as meaning. That's the manipulation, not a villain. Your own need for certainty. Now let S get specific about what to watch next without pretending we can predict the exact next candle. There are a few zones that matter because they represent the points where the market already revealed itself. The record to high volatility region around the $80 handle is now a psychological ceiling and a trigger zone. If price approaches it again and you see the same chunky tape and tightening spreads, that's your warning that forced buying may be returning. On the downside, the low 70s area, where the air pocket found bids, becomes a reference zone. If silver can hold that region on pullbacks, it suggests the liquidation was a flush, not a reversal of regime. If it slices through that region and stays heavy, it suggests the event was more blow-off than breakout, at least in the near term. And that's not the part that matters. The part that matters is what confirms it. Confirmation is rarely price went up. Confirmation is that dips get absorbed quickly and cleanly without collapsing the curve. Confirmation is that volatility spikes don't break the market structure into lower lows that persist. Confirmation is that any renewed upside push is accompanied by stress signals in the plumbing: front-end strength, unwillingness of spreads to relax, and the kind of buying that looks like it has to happen. Weakening signals are the opposite: soft dips that keep bleeding, a curve that relaxes into easy contango, and a market that starts behaving like a normal risk asset again rather than its own regime. Now, about the institutional behavior piece, this is where you have to be careful and mature. You do not need to believe in cartoon villains to understand incentives. Institutions manage risk. Dealers manage inventory. Funds manage drawdown limits. Exchanges manage systemic integrity. When silver spikes, every one of those actors is forced into decisions that can move the market, regardless of their personal beliefs about silver. That is why these moves can look coordinated, when they are actually just a set of incentives firing at once. And that's why the most dangerous phrase in this market is, they would never let it. Markets don't let things. They respond to constraints. and constraints are tightening when volatility rises. So here's the two scenario lens you need for the next week or two, because it keeps you grounded and it stops you from falling in love with a single narrative. Scenario 1 is the controlled pullback and retest. Silver consolidates, it chops. It tests the prior support zones, think that low 70s region, without collapsing. It grinds higher in an uneven way. Volatility remains elevated, but the market stops doing the sudden trapdoor drops. In this scenario, the thesis is that the liquidation event removed weak hands and undercapitalized leverage, and the market is rebuilding for another attempt higher. What confirms it is simple: pullbacks that get bought quickly and a structure that keeps respecting higher lows over a meaningful window. What weakens it is persistent heaviness, rallies sold hard, and supports that don't hold. Scenario 2 is the continuation squeeze with gap risk. Silver re-enters a forced flow phase. It pushes back toward the psychological highs, and liquidity thins again. This is where you see the most dangerous kind of tape: fast moves, limited offers, and that feeling that the market is moving without you. In this scenario, the curve and spreads become the loudest warning system. If the front end tightens and refuses to relax, even as price rises, it suggests urgency. If collateral requirements keep getting adjusted and volatility remains extreme, it suggests participants are still under stress. The risk here is not just downside. It's that moves can gap both ways, up on forced buying, down on forced de-risking. And if you think that can't happen to you because you're right, that's exactly how volatility eats you. Now let's talk about invalidation, because credibility requires it. What would make the event revealed a new regime thesis wrong in the near term? A clean, sustained breakdown below key support zones where buyers previously defended, combined with a curve that relaxes and a market that stops showing urgency in the front. In plain language, if silver falls through the low 70s reference area and can reclaim it, and the market starts trading like the stress is gone, then the spike looks more like a blow-off than a durable shift, at least on the near-term horizon. That doesn't mean silver is dead. It means the setup changes. And pretending it doesn't is how people turn a macro thesis into a personal crisis. If you want one metric to watch that cuts through the noise, it's not a rumor about who blew up. It's whether the market keeps demanding metal now rather than later. Watch the front end. Watch the spread behavior around the active contract. Watch how price reacts at key levels when liquidity is thin. And watch the reaction function of the system, margin, volatility controls, and how quickly leverage positioning is forced to shrink. Because those are the levers that create liquidation events, and liquidation events are what create the impossible candles. Let me give you the clean checklist for the next 2 weeks. No hype, just mechanics and observation. First, respect the fact that price can whip around violently even if the thesis is correct. If you cannot emotionally tolerate a 5 and 10% move in days in silver, you do not lack conviction. You lack fit for the instrument's volatility profile. That's not an insult, it's risk reality. Second, separate your time horizon. Are you watching this as a short-term structure trade or a macro regime shift? If you mix them, you will buy because of a long-term story and sell because of a short-term candle. That is the classic failure mode. Third, watch the levels that already proved themselves. The prior support zone in the low 70s area is your does the market catch itself? Test. The region near the highs is your does forced buying return? Test. Fourth, watch the plumbing on the next push. If price rises and the curve tightens, stress is returning. If price rises and the curve relaxes, you may be seeing relief and rotation rather than a squeeze. Fifth, watch how the market behaves after the next margin or volatility adjustment. If tightening triggers immediate dumping and weakness that persists, leverage was still the primary fuel and the tank is being drained. If tightening triggers a sharp flush and then the market rebids quickly, it can mean strong hands are absorbing the forced selling. And finally, watch your own behavior. If you catch yourself needing the bank failed story to feel justified, that's a warning sign. Markets don't pay you for being morally correct about institutions. They pay you for understanding mechanics, managing risk, and staying coherent when volatility tries to turn you into a headline reader. Because that's the real game here. This is the part where I'm going to make a request that doesn't feel like begging, because it's about identity, not clicks. If you're the kind of investor who wants the unglamorous truth, the spreads, the curve, the forced flows, stay in this lane with us. The crowd will chase the rumor. The serious money watches the mechanism. And the more people in this community who train themselves to read the plumbing instead of the hype, the less likely you are to be the liquidity someone else needs on a bad day. So here's the bottom line. The spike was real, but it wasn't belief. It was structure. The drop was real, but it wasn't the story is over. It was leverage getting priced. The next move will tell you whether the market is rebuilding or unwinding, and you don't need a name to see it. You need the curve, the reaction at the levels, and the way liquidity behaves when the system tightens again. If the front end tightens and those dips keep getting absorbed, the market is warning you that the pressure hasn't been released. If supports break cleanly and urgency disappears, the market is telling you the event was a purge, not a new permanent state. Either way, you now have the framework that keeps you sane while everyone else argues about villains. And in silver, sanity is alpha.